All right. It is Cinco de Mayo, May the 5th, 2023, and we are back for another Friday financial wrap with Mr. Michael Zuber. How are you, Michael?
I'm doing well, man. Cinco de Mayo, big day, big day. Got to go have some Mexican food.
Yeah, for sure. So let's get right into the show. A lot going on this springtime, man. What a crazy week again. Let's talk about the Fed, 25 basis points. Your thoughts this week?
Yeah, we got 25 basis points. Everybody and their brother expected it. What is more important is I believe we are now at the terminal rate, which we've been calling for 6 or 9 months. So we're here now. Um, Powell did put pause on the table for next month, which I think is a mistake. I think we've seen this is just wild. The Fed raises rates 25 basis points. The 10-year note goes down and mortgage rates go down. That's,
Yep.
The market now is pricing in a pause. There's 3 cuts expected. It's just a mess. What is most important to you and I and our followers is we're at the terminal rate. I think mortgage rates go down from here. We have a big, almost 300 basis point spread between 10-year and the mortgage rate. And I think that over the next couple of months comes in. I think we're sub 6% by late summer, which again, 6% is a psychological barrier for demand. We've seen that twice this year. So, and I don't think supply comes. So we're going to be dealing in a pretty competitive market below the median pretty much all year. So that's what we're thinking.
Pretty wild. Pretty wild. So let me just throw on something here. Any thoughts about First Republic, the collapse of First Republic, the absorption of First Republic? Just in terms of the Fed, was there any kind of connectivity there of, okay, are we going to see some more contagion on banks? Does that play into the Fed going forward? And that's why we see expectations of maybe rate cuts, or just maybe your thoughts there about the banking.
Yeah, so I think so. First Republic is just the last. It's the last one that happened. There will be more. I think the market is already screaming. There's a couple more right on the precipice. So yeah, there's going to be more. I think we talked about this months ago. Think this is the savings and loan crisis on repeat. What does that mean? It means we'll have bank failures all year, right? It's not going to be just bank failures in a month or two. It's going to take time to unwind. I think First Republic going out hurts the jumbo loan market. They did a lot of jumbo loans. I think it's another reason for commercial banks to get tight. I think it hurts commercial lending even more. I think there's just a lot of regional banks that are going to be very, very conservative, and that's going to hurt commercial. It's going to hurt small business. It's going to be painful for sure.
Interesting time. So let's continue. Let's talk about housing inventory. What did you see this week? Your thoughts here for this last week or so?
Yeah, housing inventory is still trending down. We got some number from realtor.com that month on month active listings were up less than 1%. It was like 0.18%. So just like 1,000 units. That's interesting because it's the spring selling season, right? We're supposed to start to see inventory pick up, and it's just not. This is the move up buyer not moving that we've talked about for a long time. It's just now we have evidence that my prediction was right. We're seeing active listings also down 20% year on year. It's just not showing up. And then lastly, it just means home builders have all the power, right? Existing home sales aren't there to compete with. Builders have the ability to throttle production and throttle price. And the housing market is very unusual right now. New builders are usually 11% of the market. Now they're 30% of the market.
Wow.
So pretty crazy.
Yeah. So let's talk about pricing. Now, again, we laugh about the crash bros, right? It's pretty obvious that, and I want to just say on record, you've called for the housing market to be flat when you kind of average out and put everything together nationwide, that things would be flat, plus or minus, up or down, very, very minimal type of movement on price. What are your thoughts on price? What did you see this week?
Well, Black Knight, it's not my opinion. Black Knight put out a data for March and prices were up 0.48%. So again, pricing is flat basically flat. It's up slightly. Certainly not a crash, which is comical for me to keep hearing. I don't know. Yeah, I just don't know how you have a crash. But anyways, that's a different story. But prices are up in March, and really, because again, I have a national reach now. Our call on the median home price and below, dude, offer review dates, 5, 10, 20 offers, over asking, and then
Yep.
luxury, slow.
Yep.
So that's just where we are, and we've been right again.
So again, we've been talking about this for months and months. A bifurcated market below the median, still red hot, still multiple offers, very, very tight inventory with strong demand, above the median value in most markets, slower days on market, prices are soft, and then of course it just kind of goes up and down the ladder from there. Is that?
Yeah, I think that's really well said.
Okay. Very interesting. So let's talk about layoffs. Let's talk about the national economy, layoffs. Your thoughts. What did you see this week?
Yeah, so you're seeing a lot of headlines about layoffs, right? Just today, Spotify said they're laying off 20% of the company. But we get weekly unemployment data, weekly, every Thursday morning. And we got the latest number. This is from memory. I think it came in at 242,000. Expectations were 240, or so 242, expectations 240, last week 230. I think in order to see the quote unquote economy breaking, you've got to get over 320. So we're still low 200s. They are getting new jobs. So the job market is still tight. And, even Powell talked about it, right? The job market is showing signs, but still pretty robust. The JOLTS report from Tuesday, job openings, leaves and quits, we're down to 9.6 million instead of 10 million, but still a really strong job market.
Interesting. So kind of going back to, I think, again, there were a lot of comparisons. You did that big report about the 1970s and 1980s, wage inflation, the way that the market appreciated in spite of the interest rates going, rising, rapid rising rates. So S&L crisis, which we did not, which is kind of a real curveball. A lot of comparisons, a lot of similarities. Would you agree? Or?
Yeah, I think so. I mean, having built that report now almost 2 years ago, it was pretty prophetic about what's happening right now. I remember building it, sharing it the first time, not really confident that what it was saying would happen, and it did. Rates can go up 500 basis points, and home prices wouldn't fall. What would happen? Transactions would fall 40 to 50%, and they did. So yeah, I'm really glad that we did that, and inflation increases wages increase. It's just a whole thing that was really dead on when we built that.
Yeah. And I mean, you did all the work, man. Amazing. I think maybe doing a summary video. I saw you re-release some stuff. I think maybe a summary video on the front and back end and re-release that.
Fun.
I think that would be, because history is repeating itself basically in a different version, but it seems very similar.
I think you're absolutely right. I will take that down as an action item. Thank you.
I love that. So let's connect the dots. Is the housing market still broken?
Yes.
Okay. And then let's talk about spring. We're coming to the end of the spring market. We're getting, leaning toward this summertime here. Do you see the completion of the spring market, summer market, continued tight inventory with rates softening? Any curveballs here, or is it more of the same?
I think so. This is really, I don't know that I've shared this anywhere else. I think what the Fed has just done. So I think we're in a recession. I've been clear about that. I think we've shared that.
Okay.
I think we're at the terminal rate, which what that means is the Fed's not going higher. We've talked about that. I think what happens here is margin compression between the 10-year and the 30-year rate. I do not see any acceleration in inventory. And we have evidence that demand picks up at 6% interest rate or below.
Okay.
I think we're going sub 6 over the next 60 to 90 days. I think we have some more banking crisis. I think commercial gets really hurt, but I don't think residential does. So, if I were to find a flip today, it would be like the ones I did in October and November, below the median, exit below the median. There's just no competition. If you have a way of finding deal flow of junk and you have a team that could polish it up, you can make gobs of money. But you got to be focused on first time home buyers.
Yep.
That's just like the only play. Like don't push yourself. Oh, I'm only 10% above the median. No, 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 no. Don't do that. Right. This is not the time to gamble.
Interesting. It's interesting too, and I want to comment also that a lot of headlines I'm seeing where they're saying foreclosure properties are going to spike, and it's interesting because tracking them and really active in that marketplace or in that niche, yeah, it could go up 300%, but that just means there's from 8 properties in trustee sale auction status that don't actually go to maybe going to 20 or 25 or something like that. Yeah, that's a 300% increase, but not significant, not going to move the needle. Would you agree?
It's insulting that people use this. It's insulting that somebody has the balls to say it's up 462%. Dude, it went from 4 to 17.
Right.
I mean, that is intellectually dishonest, but it doesn't matter. It's true. You could say they went up 462% and you could probably sleep at night. But dude, it went from 4 to 17. Give me a break.
Very interesting time. So let's talk about, you went to an event, and I think it's significant because you're not a guy, you go to events to speak, you share. You were there specifically as a paid student there to learn.
Correct.
And so what did you walk away from? Tell the listener, what was the event? And then what did you walk away with in terms of thoughts, knowledge?
Yeah. So if people follow my channel, I've been very clear about 2 areas of my real estate tool belt that I am weak at, or weak meaning they're tools that I don't have. One of them is creative financing, kind of pace more, be sub 2. Don't know it. Need to go figure that out. The other one was bigger multifamily, right? Bigger multifamily, meaning just bigger units. Also, perhaps being a limited partner or a general partner. There's just areas I've never played. So that was the event we went to. We went to an event where Olivia and I were guppies compared to everybody else. And that was fun, right? That was uncomfortable and fun at the same time, hobnobbing with people doing 50 and $100 million deals. And it was eye-opening. So I got exactly what I wanted. First, I don't want to play there. I mean, I don't want to raise money. I have no problem raising debt, but I don't want to raise equity because I don't want to put anybody out like that. It's just not where I want to play. Second, I thought there was a lot of opportunity coming. It's even bigger than I thought. There are lots of operators that have bad debt structures that have to sell. There are lots of owners of property who either will fire sale it or get it foreclosed. And unfortunately, general partners will choose to fire sale, wiping out their LPs so they prevent a foreclosure. Like the death knell to a general partner is a foreclosure on your record. So they'll file sale. So I think there's gobs of opportunity coming. And there were people there talking about institutional type assets. Think Grant Cardone. That kind of stuff we'll never see. And I mean, Grant Cardone's a buyer, not a seller, just so we're clear, right? There'll be people with trophy properties. He'll get the opportunity, all of that. But there'll be the 20 to 50, 20 to 60 units that's below institutional buyers. They have the same problems.
Yep.
So I got exactly what I wanted. And oh, by the way, I got to network with 10 or 12 one rental at a time fans that went as well. So it was pretty cool. And Olivia went. She got to meet some people, so she does exist. We took a picture, so she does exist. So yeah, I had a great time. It was fun. Then we hung out with Vegas a little while. We met with Brian Lebo, somebody who's been on the channel a couple of times. So yeah, it was a great time. I'm glad we went.
I love it. So question then, multifamily, the commercial segment, is there a tsunami problem with regard to debt structure? And compare it to 2008 in housing. How does it compare? Just your general thoughts walking away from that event.
So I'll actually go up a level. If you take commercial, which is multifamily, office, retail, industrial, all of that, dude, it really could be bigger than the Great Recession. It will impact less people. Like I'm talking volume of dollars, right? It could be bigger. It won't be the same kind of pain because the Great Recession pain was all debt because all the loans were at 97, 98, 99%. The commercial stuff, what people don't realize is a lot of that, 30% of that is equity. So you take a 30% haircut, the debt's fine. So it's a totally different ballgame. But yes, there is a tsunami. It is largest in the office space. It is large in retail. It is problematic in multifamily, right? But yeah, and oh, by the way, the pain in commercial is not only bad deals, but as we learned at the event, Ty, there are people. Think about this: you own your home today. You have never missed a payment. The bank comes and knocks on your door and says, "Dude, Ty, sorry to do this to you. I know you're a great credit. You're my buddy, my boy. We go golf all the time, but I got to call your loan because I need your cash." They can't do that in residential. They can in commercial. They pull up one of these freaking debt loan covenant things and blingo bango. They can call your loan. So it's going to be dicey.
Wild times, wild times. So, Michael, one of the big things we've talked about, getting to 50,000 subscribers. Our call to action today is very simple. If you see value in the show, you see it right above Michael's head there. What does it say right above your head, Michael?
Subscribe, subscribe, subscribe.
Where are you on subscribers? 40?
Almost 47,000, 46,860 last time I checked.
So 3,300 subscribers to 50?
I think so.
Okay.
Yeah.
Help us get there, folks. If you love the show, if you like the show, if you get value from this show, please subscribe. Also, like and share. Michael, thank you for all that you do. Have a great weekend.
You too, bud. Take care.